Hello, welcome back. So in today's video, I'll be talking about the deepest value buys by your super investors this quarter. So in today's video, I'll be covering a few things. We'll be covering the deepest value buys by your super investor, ASML stock research, as well as some questions that you guys have left me in the comment section below. So let's talk about the first portion first, which is your deepest value buys by super investor. And the first super investor on this list is Michael Burry. So Michael Burry has 100% of his stake in Estee Lauder this quarter. But I don't think he has 100% of his portfolio in just one stock. He likely opened a lot more long positions after the April dip that we had. So Estee Lauder is a company that is down around 80% from its highs, and currently the stock is giving out a 2% dividend yield and the earnings are negative on this one. So for Estee Lauder, this is their recent earnings. The recent earnings show a 10% decline in net sales, gross margins dropped by around 6%, gross profit dropped by around 6% as well, and operating income dropped by 42%. So overall, the company is in a transition phase. It is significantly reducing its workforce, and it is undergoing some form of cost-saving strategy as well. So Estee Lauder is a company in transition, and that's why you're seeing the company losing a lot of its earnings. It has a lot of its earnings from China as well, and that's why the net sales is down this year. So for Estee Lauder, it is one of the largest player in your beauty space. It has currently now around 6% of the total beauty space. And you have other companies like L'Oreal, Unilever, Procter & Gamble, oh that's an interesting one, LVMH, Chanel, and all your different other luxury brands in this portion as well. So for Estee Lauder, these are the tailwinds for the business. So your beauty segment is projected to grow at around 7% year on year until 2030. So Estee Lauder, being a dominant player in the space, will likely grow at the same rate as well. China's sales will recover with stimulus checks, and the brand power with their brands like Clinique growing double digit will be strong for the company. And overall, the company is sort of having a turnaround. So they had a lot of inventory post-COVID because they didn't time it very well. They saw an increase in earnings and an increase in demand, and they stocked up a lot, and currently now they're clearing the inventory that they had 2 years ago. So that was a mistake by management. They didn't foresee the fact that your stimulus checks was artificially bumping up earnings, and they stocked up a lot of inventory, and that is causing the company to lose earnings currently. And so once that portion is fixed, Estee Lauder will likely return to its normal historical earnings profile. But for Estee Lauder, this is why it's an avoid. Estee Lauder is in a space that is highly competitive. So your celebrity brands as well, like Fenty from Rihanna, Beyonce coming out with a brand as well, and then all your different other celebrities like Hailey Bieber with her Rhode brand, and Kylie Jenner, and all your different other celebrities as well. They can come out with their own makeup and skincare line, which will hurt the legacy business and steal market share from them. So market share has been decreasing over the past few years, and you will likely see this trend continuing unless they can innovate and create products that people want again. So they are an innovator, and there's product innovation risk. So when you are an innovator and not the distributor itself, you need to create new products and constantly attract new customers into your space. So the company's stock price is falling with its earnings. It is not falling independent of its earnings. And typically when that happens, it signals a fundamentally weak stock. And that's why for me, Estee Lauder is a company that I would avoid in this space. I think a much better company is a company that has no innovation risk, like Ulta Beauty, although Ulta Beauty is currently now fairly priced as well. Next super investor is Bill Ackman, and this is Bill Ackman's ad. He added a lot of Nike. He converted his stock into deep in the money calls, and currently the stock is down 17% year to date, trading at around a 20 times earnings. So for Bill Ackman, this is his take on Nike. He's saying that Nike's turnaround is in its early stages as new CEO Elliott Hill lays the foundation to drive sustainable long-term growth. Nike is the market leader in your high-growth athletic footwear and apparel industry, and its dominant market position in the highly consolidated athletic footwear industry creates formidable barriers to entry. He believes that current full-year margins are severely depressed and can more than double in a successful turnaround. He also acknowledges that Nike's 2024 earnings were quite disappointing, but he is in deep belief that the new CEO, which is your Elliott Hill, can turn this company around and bring this company back to its growth path that it had a few years ago. So for Nike, here are some of the tailwinds that I can see for this business. So Nike is returning back to Amazon. Nike in 2019 or so, they stopped selling on Amazon because they saw their sales hurting in Amazon itself. And Amazon at that time isn't the Amazon that it is today, and it wasn't able to stop Nike's counterfeit products to stop selling on Amazon itself. So Nike is now returning to Amazon. This will be huge for their direct-to-consumer business because Amazon will also ban third-party sellers from selling Nike products, and this is a win for their D2C business. So Nike is planning for their D2C business to increase to around 60% in 2030. I see this as a very good move because it lowers the cost, it lowers human capital costs, and increases the margins for the business as well. And for footwear, it is slightly different from skincare. Skincare, normally people want to try it at the store, but for footwear, you can simply just buy it online. And D2C is likely a lot more scalable as compared to retail foot traffic. But this is my problem with Nike. Nike has a lot of competition in the space. So competition is for losers and Nike has a lot of competition, so it is not a stock for me. So Nike in 2023 had around 15% of market share in your footwear industry, but currently now it has dropped to around 14% of the entire market share. So you have other companies such as Adidas gaining market share, New Balance, On Holdings, Hoka, all these companies that are gaining market share from Nike, and I expect this trend to continue as well. Footwear companies are generally very low barriers to entry because you can simply just create a footwear, stick a brand and sell it to consumers and popularize it. So generally Nike's barrier to entry is quite low, and that's why I don't think this company is one that I'll be investing in. Next one is Seth Klarman's bet. Seth Klarman's bet is in Google. So Google is currently now down 9% year to date and it is trading at a 19 times earnings. So for Google, this is Seth Klarman's activity over the years. Seth Klarman has successfully traded in and out of Google every single time. He's basically bought every single dip and sold at every single top. And overall, he's been quite successful with his Google trades. So this could be a signal that Google is currently trading at a decent valuation for him to enter and to trade the stock. So for Google, here are some of the headwinds for the business as usual. So you have your LLMs and the cannibalization of their cash cow, which is Google search. So they have concentration risk as well. 2/3 of their profits come from Google search, and it is operating in a cyclical market as well. So your advertising portion, it is highly cyclical. Once your economic conditions turn sour, then your advertising spend will come down significantly, which will hurt Google's revenue as well. So if you look back at 2022, look back at Google as well as Meta's earnings, their earnings declined massively because the economic conditions were not very sound. And that is what you can expect to see happening to Google as well as Meta if we ever go to an economic downturn, which is a risk for this company. But I think Google is less concentrated as compared to Meta. Meta is almost 100% in advertising. So here are some of Google's tailwinds. So Google's valuation now is not very demanding. It is currently trading at around a 15 times earnings if you are to do a valuation by parts for its Google search business. And the Google search portion is growing at around 12% year on year in terms of revenue. So Google is leading in AI. It has the best coder, the best video generator, and it has the best LLM currently as well. Google is monetizing its LLMs outside of just subscription. So for example, ChatGPT, your Anthropic, all of them, they're using a subscription-based model. But for Google, they're going one up on that. They're introducing ads into their chatbots as well in AI mode, and that could be a tailwind for this business to basically increase the return on each query that is being asked on Google. So for Google, they're creating an ecosystem as well. They have the workspace that's coming up, and that workspace can incorporate all your different other Google platforms like your Gmail, Google Drive, and you can basically just ask Gemini. So Google is the first of many companies creating an ecosystem out of AI, and I expect all the other companies to do this as well in the future. Google is currently leading. It needs to continually innovate, and that's the problem in the business. So this is my Google summary. The company has risk, but the valuation is not very demanding at 19 times earnings. The company will likely not be disrupted in the next few years at least. And if they can go all in on AI and get the returns, the company can go back to an AI multiple of around 30, 35 times or so. And then the stock price will likely double with its earnings acceleration as well. But on the flip side, if this company gets disrupted, then you can likely see this stock price going down to around $90 a share, which is what YouTube as well as cloud is worth. So for Google stock, it is a high risk, high reward play currently in my portfolio. I think this is one of my riskier bets in my portfolio, but I see Google's stock price and Google's valuation as extremely compelling at this price, and that's why Seth Klarman is adding into this one as well. Next portion, I'll be talking about ASML's business. This is an article that I found which is on ASML architecting Earth's most complex machines. So this article says that today it is hard to imagine that ASML was viewed as a likely failure when it emerged from Philips and ASM in 1984, despite the absence of commercially viable products and a workforce that many believe had been handed a ticket to nowhere. The company managed to establish a technological monopoly within the most advanced chip manufacturing equipment, which is your EUV lithography. This is the story of ASML, the architect behind the Earth's most complex machines. So this article also states that when a chip manufacturer such as TSMC or Samsung invests in one of ASML's machine, it is not just purchasing a piece of equipment, it's acquiring a long-term asset and a multi-decade long partnership. So these machines are built to last. In fact, ASML recently shared that 90% of all lithography machines last up to 30 years. So they are still operational as well. Even the OPS 5500 systems are still churning out chips. and they also offer 24/7 service at the ASML machines in operation. So for ASML, they have two different portions of their business. They have the net system sales, which is the portion where they sell their machines, and then they have the installed base portion as well. So the installed base portion is almost 100% retention rate. Why? Because all these companies, they will need ASML personnel to be at the site to maintain the ASML machines. So it typically takes around 5 years for an ASML personnel to pick up the skills to maintain the machines. And for ASML, that portion of the business is simply incredible. Why? Because they have the current machines now that they can work on, and adding on to that, you have 400 plus machines every single year coming in as well. So it is an incremental amount in terms of your installed base, and all these machines, they last up to 30 years. So that is a guaranteed 30-year contract that ASML has with TSMC, Samsung, Intel already, because they will have to hire ASML personnel for 30 years to be at site to maintain the machines. So for ASML, this is a highly profitable business, and the installed base management portion of the business is a portion of the business that is often overlooked by investors. It is a high quality portion of the business on top of the monopoly in the EUV segment. So for ASML, they are a business of assembly as well. So another important aspect of ASML's business is its sourcing and assembly business model. Despite selling the most complex machine on earth, roughly 90% of its parts are developed and supplied from third-party sellers. So one ASML EUV machine contains 700,000 components. To put that to perspective, a typical car has around 30,000 parts. So for ASML, they don't make the parts itself. For example, they get the mirrors from another company called Carl Zeiss. And for this business over here, the reason why it is so high margin is because it doesn't have to go and manufacture its own parts. It is sort of like a middleman assembly business where you get all the parts from everywhere and then you assemble a machine and then you sell it to your customers. So this is why ASML has incredibly high margin, and it will continually do so over the next few years. So for ASML, that is why you're seeing all your different super investors buying into this one. So you have Triple Fawn as well as Pat Dorsey. These two super investors, they focus on high quality business, specifically Triple Fawn. So Triple Fawn, if you have to look into their portfolio itself, the portfolio is quite remarkable. The portfolio is quite incredible. It is filled with high quality stocks, and the fact that they added 7% of their portfolio to just ASML, which is just one stock, is quite incredible in one quarter. Pat Dorsey as well, adding 5% at one go. It clearly shows that ASML was quite undervalued in Q1. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one, it says, what about SMCI? Isn't it undervalued? Revenue last year was almost equal to CoreWeave's entire year of earnings, yet it is priced under 40 while CoreWeave's is above $100 a share. So first of all, don't look at just the stock price alone, look at the valuation itself. Yes, SMCI is slightly undervalued as compared to CoreWeave's, but if you have to compare the valuation of SMCI as compared to another company like for example Nvidia, I'm not too sure how the valuation will fare. As for SMCI, what they do is they sell the cooling racks for your data centers. And for data center plays, I think the best way for you to participate in them is simply just to invest in the hyperscalers. So Amazon, Microsoft, Google as well. I see most of the semiconductor data center plays as highly speculative. And for SMCI, you have the accounting fraud headwind as well. And I'm not comfortable holding a stock that has some history with that. It could be a company that simply just goes bust in the future. And so for SMCI, I don't think I'll be investing into this one. Next one, thoughts on the Gold ETF. Price chart seems extremely steady. So first of all, I don't like investing in non-cash generating assets. So gold, for example, is a commodity. It doesn't generate cash flows. It's similar to Bitcoin. Bitcoin is another speculative asset that doesn't generate cash flows, because by being cash flow generative, you can increase the intrinsic value of the business itself. But for gold, the only way for you to make money out of it is to sell it to someone else who wants to buy it at a higher price as compared to you. Whereas for your stocks itself, a way that they can return cash to its shareholders is through dividends, and the company itself is likely cash flow generative. So I'm not interested in buying any form of commodity. Even if gold goes up 500%, I don't think I'll ever be interested in buying gold. Last comment, it says, can you make a video like this but in reverse? High risk, shorter term investments, 20 to 30% a year is not enough for me. So the greatest super investor in the entire world, which is Warren Buffett, has achieved around a 19% annualized compounded annual growth rate. And so if you're thinking that 20 to 30% is not enough, then I think you're asking for too much. As for getting 20 to 30%, I think that is a bit of a stretch. Typically in the stock market, you can expect around a 10% return. And these are the comments that you'll likely see in bull markets. When bull markets, they increase the expectation of return so much that everyone demands a high return. So we had 2 years of 25% plus of returns in the stock market, and now people are expecting continual 20-25% in the stock market. This is dangerous, and I don't think as an investor expecting 20 to 30% every single year is a benchmark that you should be having. the realistic return for investing in the S&P 500 should be around 10%. And unless you're doing quant trading, which is what Jim Simons does, then I don't think 20 to 30% is very much sustainable over the long term. Of course, you can get one off year where you're extremely lucky and you get 50% return, but over the long term, like Warren Buffett, you will likely not be able to do so. I hope you guys have found this one useful and invest